This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Welcome back to Futures Edge. This is the second installment of Futures Edge. Thank you very much for all your feedback and the first time. Thank you much for joining us here. If your week was anything like mine, your hands probably still shaking a little bit. I feel like I've aged 10 years. On this show, we're going to talk about a couple different asset classes. Today, we're going to hit currencies, we're going to hit crude, we're going to hit stocks, and we're going to hit, of course, bonds, because bonds is what started this whole thing from that temper tantrum they threw yesterday. We're going to talk about ways to use futures to either hedge risk or express a directional bias. We like to look at it from kind of a macro theme and then boil it down to specific trade examples. We look at futures, people think of futures as this, highly leveraged, dangerous product, and it is. We're here to try to teach you how to harness that power to work for you. We have one of my favorite guests, someone who I've worked with in different media things for quite a bit of time, Carly Garner of DeCarly Trading. I think she's one of the smartest people in the business. One of the things I like about Carly's books is I read Carly's books and she takes really, really complex issues and boils them down for anyone to understand. Carly, thank you for coming.
Absolutely. It's my pleasure.
Good. So, okay, I mentioned bonds, and bonds threw that temper tantrum yesterday, and we're going to talk about that plenty throughout the show. But sure. Underlying everything, in my opinion, is the U.S. dollar. U.S. dollar is the dog. Everything else is the tail. Even when the bonds are sinking yesterday, they're worried about a collapsing dollar. What themes are you seeing in currency markets?
I agree 100%. So obviously the big story is the government is stimulating the economy, printing money, so on and so forth. We've all heard it. We've all read it for months now, and it's weakening the dollar. The thing to keep in mind, though, is if you look at the COT report, which is the Commitment of Traders report issued by the CFTC, everybody and their dog is already short the dollar. Everybody's already bearish the dollar. It's very rare to see anyone on TV or on blogs on the internet that thinks the dollar is actually going higher. Believe it or not, I do believe that eventually it will. If you look at some of the chart patterns in the currency markets, particularly the dollar index that's traded on, the dollar index, which is like a composite of currencies versus the US dollar. The bottoming process in the dollar is generally, it's a process, not an event. It's not just a single day. It happens over weeks and months. The last 3 or 4 bottoms we've had have been very similar to what we're seeing now. That doesn't guarantee we're going to bottom out, but it looks to me like we're trying to carve out a range between like the high 80s and maybe 100, 105. And if that's the case, I think we hold this general area and move up. But if that happens, it's an if. Nobody knows. I can't see the future. I know. Maybe you can. I can't. But if it happens, and I think there's a pretty good chance it will, that will really change the entire landscape. It's going to put some pressure on stocks and commodities.
Okay, here's the question. If the dollar's going to bounce, are you saying it's because too many people are short the dollar and it's just a market positioning? Or, yesterday the yield curve started to try to convince us all that we're pulling tightenings up till late 2022. Is it the fundamental reason of potential tightenings, or is it because of the position?
I think there's a couple things going on here. And to be 100% transparent, I've thought this for a few months and we've just been kind of trolling around. So it hasn't happened yet, but I do think this is what's going to happen. First of all, usually when everybody believes the market's going to do one thing, it does the other, because everybody that's already bearish has already taken action. So I do think I think a lot of it is simply that. But I also think if I was overseas and I looked at yields around the world and I saw the US 10-year note, 1.5, 1.3, that looks pretty good to me compared to really anything else. Everywhere else we're trading 0.5% or less, even some places are almost negative. So I think that we're going to see some money flow in to buy some of those risk off assets like the 10-year note. And I think that'll push both the dollar and the 10-year note up. I know that's not a popular opinion, but that's what I have on my
No,
radar.
the trade I'm gonna talk about in a couple minutes. I actually went long, very kind of low risk 10-year
Right.
trade based on
like
that
it.
same exact thing you're talking about. So I like it.
Okay.
Okay, so of the
Perfect.
currencies, of the specific pairs, if the
Mhm.
dollar rallies back, what's going to get pummeled the most? Is it going to be just as simple as the euro and the yen? Because there are other countries that have terribly high debt loads just
Right.
like us.
I think the euro is probably going to get the brunt of it. If you look at a monthly chart in the euro, we're really well, not today because the euro sold off, but a few weeks ago we were right up against the downtrend line in the 122-ish area, 123-ish area, and I think that holds. And if it does, we should see the euro trade back to 110. Again, not a popular opinion, but I think that's what's going to happen. I mean, if you look at, I think it's going to eventually come back to the story that we were talking about a few years ago, where the U.S. or the dollar is kind of the least um, the least trashy trailer in the park. I don't know what else to say.
There's
So,
about 10
yeah.
metaphors. I was wondering which one. I was hoping you were going to
Yeah.
mix a bunch of the metaphors. The cleanest
Right.
shirt, the tallest midget.
There you
And
go.
remember, this isn't. You can say whatever you want here. This is just a couple traders talking. You could swear. I think. I hope
Okay.
so.
I might. No, I'm kidding.
So,
I won't.
no, that's interesting. Now, when you look at the dollar index to me is troublesome in that it's really just gravitated 75% euro and yen. So it's basically just looking at the dollar against the euro and yen. What other currency are you looking at that might be interesting to people?
So I look at the Canadian dollar a lot because the Canadian tends to be correlated with commodities, and I do happen to believe the commodities are vastly overpriced. A lot like what we're seeing in the stock market, where fundamentals and price action has just kind of there's just really not a big connection there, honestly. It's a lot of speculative money pushing things higher for odd reasons. The weirdest thing that I've learned in the last couple of months is trading is no longer necessarily price speculation or risk reward. It's become something that is like, is it environmentally friendly or is it not? Like I've had people actually contact me and they're concerned they didn't want to buy Bitcoin around 40, 50,000, not because they thought it was overpriced, that had nothing to do with it, but because Bitcoin uses a lot of energy to produce, and that was their concern. So when you start hearing these stories where there's really so much complacency in regard to risk, it really intrigues me. So we'll see how it plays out. I don't know.
So that's what you're saying, to put a fine point on it, is when
Yeah.
people are concentrating on the environmental impact and not even necessarily mentioning the price or the risk,
The
you
risk,
think that
right?
yeah, you think it's like when you see the VIX at 9 or whatever. It's like people are underpricing what the potentials are. No, I
There's
get that. And we see
yes.
things like happen. Yeah, when we saw what happened in GameStop with those hedge funds short those way out of the money calls, those are
Yeah.
just people who didn't consider the risk. And I don't care what happens
Yeah.
to them. Do you agree with me on that?
I'm not going to call anybody out in GameStop, but surely, obviously, there's some complacency there, and I think there's complacency in a lot of places. People that I've talked to, I mean, whether it's social media or just in everyday life, people have come to the conclusion that the stock market's easy money, and you buy call options. There's a famous TikTok video that went around. The strategy is easy. You buy calls when the market's going up, and then if it looks like it's going to go down, you sell them, and they make money, and they say you can quit your job and
I
do
saw
that.
that.
And it's like shocking to me that even people think that that's reality. So when there's that kind of mentality going around, it's really concerning.
Okay, we got to talk about crude. I feel like
Okay.
I could just go on all day. A quick story about the stock market, real quick. This will take 10 seconds. I got a call about 3 weeks ago from a woman who I'm good friends with, and she's very smart. And she said, "Why wouldn't I just put my savings, my short-term savings, in Tesla? It does nothing but go up." And I did. I swear to God, I sold Tesla after that. Okay, now let's switch to crude real quick.
Okay.
What now? What happens in crude?
So it's so ironic. Earlier this year when everybody was bearish crude and it was just dumping, I boldly and probably stupidly came out and said, we're going to see $60, $70 again in crude. That said, I never, ever thought it would be this quick. To me, it's just too far, too fast. And I made the mistake of turning bearish too soon. So I've been kicking myself for that. But with that said, I think the speculations kind of run rampant. It's the exact opposite of what we've seen in March. if you look again at the COT report, we're getting close to net record longs in crude oil. Like in the history of crude oil, we haven't seen more people net long than they are now. And that's a little scary to me, given the fact that the market's probably pricing in a full coronavirus recovery, and we just haven't seen that yet. I think that we're just really way ahead of fundamentals. So
don't you think? Okay, so it is. I believe it's pricing it in too, and I do believe it could be a buy the rumor, sell the facts sort of thing. But
sure.
do you, when you look at it, and I know this is just opinion, when you see what's happening and developing, and you're in Las Vegas, we're in Chicago, do you believe, just an opinion, that in June 95% of this stuff is behind us?
Seeing what I've seen in Las Vegas, I do not think so. I would love to believe that, and I hope that that's true, but I just feel like this is going to linger a little longer than what everybody's betting on right now. I mean, if you look at interest rates, stocks, crude oil, we've really priced in post-coronavirus economy, and we just are not. I just don't think we're there yet. I hope we get there. I hope I'm wrong, but I don't think that's the case. And also going back to the dollar, if the dollar does find a way to bottom and move higher, like I expect, even if nothing else changes in crude oil, that's going to put some pressure on it. I mean, just a stronger dollar alone could put crude 50s, high 40s.
Okay, so you mentioned the dollar and its relationship to crude. You mentioned commitment of traders too. Can you give me a couple other important indicators you look at? And is it EIA? Is it stockpiles? Is it what kind of things do you look at the mostly to determine where crude's going next?
I tend to focus on chart and COT and sentiment. I do follow a sentiment service that tells me what other traders are thinking, other industry insiders. And usually when they get a little lopsided is when things start turning the other way. I'm not going to say an exact figure, but I think the last I checked, almost 80% of industry insiders were bullish crude oil. And when it gets that far overcrowded, generally it's hard to make additional gains. Now, that's not an exact science. So that doesn't mean we can't go to 65, maybe even 66, but the bulk of the buying is probably behind us. But
when you see is 80%, is that an astounding number? Have you ever seen it higher than that?
Very rarely. I remember in recent history, the only thing I've ever seen a little more lopsided than that was just earlier this year in the grains. I think there were like 18% people bullish corn, and now we've seen what happened since then. So
no doubt about it. Yeah.
Yeah.
Hey, what else? Anything else? Do you look at miles driven? Do you look at anything like that?
I don't get into the details of that sort of stuff because fundamentals are hard. The fundamentals in the long run will matter, and price will follow fundamentals, but it can take months or years. And so as somebody that's trading or watching leveraged vehicles, trading on fundamentals is a really tough game. So I focus on the charts, I focus on currencies, the COT report. I do look at inventories. If you look at crude oil inventories, sure, we've seen some draws, but all in all, inventories are actually quite high historically. So
one thing that Carly just said that I agree with 100%, and I think this is what you said, is that of crude of almost everything, there are people out there who know they're the crude buyers and the crude sellers, and for big, huge companies, they know more about crude than we do. The only thing that's pure and the only thing that can really teach us a lesson, I think, is price, because everything we find out, somebody else knows ahead of time. Do you agree with that?
I agree. You're good at this. Yes. Thank you. Good explanation.
Yeah. So anyway, thank you. Carly's out in beautiful, sunny Las Vegas, someplace that I'd like to be right now. How's the weather out there? Is it okay?
It's awesome. Aside from the wind, it's sunny and warm, so we're loving it out here.
Good. Thank you. It's getting sunnier in Chicago and warmer in Chicago, but I think we have different definitions of what warm is. But thank you so much for joining us, Carly. It's good to talk to you as always.
Thank you.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Bobby?
It is called the Market Think Tank, and I just got trading cards. Can you see these?
I want some of those. Those trading cards are so valuable to me. They're perfect.
Aren't
I
they?
love those.
I
Those
got
are what
the
we used to use on the trading floor. I still use them on the trading floor, but Bobby doesn't.
got the
Yeah, I
box.
love it.
Yeah, so I use them here at the house. Like I literally have a stack of them, and I write trade notes on them. You know, so like literally, like you can see this card, for example. I don't want to show the trades, but I still write all my trades on there. Things that I do, I still write on those trading cards.
I love that. Okay, you experienced this week the same as me. There's been stock market volatility. The bonds had an absolute tantrum. We talked about the dollar and we talked about crude. I personally think stocks and the bonds are marching. We're going to save that for the last 8 minutes of the show. But let's talk about currencies right now. What do you think? Where's the value? What's your example here of how to express it?
So it's funny. I was really still bearish the dollar. And then I talked to Carly actually about her opinion on the dollar. And I think her range makes a ton of sense. That sort of 80s to 105 that she talked about when you were talking to her about it. And I think that dollar range makes sense. What I really like right now is the juxtaposition of vaccines and the tradable currencies at the CME. And essentially that just directs me toward the British pound. And the reason I say that is because they are basically in third place in vaccines. Israel obviously is running away with it. Over 50% of their population vaccinated. Over 93% of their elderly are already vaccinated, people over 60. US is in second. We're ramping up and we're getting where we should be. Great Britain's third. And I don't think people realize that. They're in third in their vaccines. The 4-stage plan that Boris Johnson put, well, I'm not sure if it's a good plan or a bad plan because that's not what I do for a living. They're starting to reopen, and I like the British economy for that reason. And I think the EU is way behind, and I think Japan is still Japan. So I very rarely trade Japan anymore, simply because it's Japan. So I like the British pound, and I actually like the 2-day pullback that we've had. And I think that given the run, today was the biggest up move in a single day for the dollar index since August. And it was the biggest down move for things like platinum since September, some of those metals. I think there'll be a short-term reversal in that. The pound fell. I think I want to buy the pound if it falls just a little bit more.
Tell me about the details.
So what I'm looking to do is to buy, as I mentioned, a continued dip. Now, this is in the March contract at the CME, and there's a full contract and a mini contract as well. I want to buy it about 138.65. So we're really, that's only about 20 ticks or so below. Let me see where we're at last. It looks like last is about, well, 139.41. It's a little bit of a ways to go. But I want my stop at 137.70, and I'm looking for us to go back up to 140. Now, we get to 140, I will likely, you talk about this with your options all the time, Jimmy, I will likely cut that before 140. But 140 is the technical target I'm looking at.
Okay, but then the levels, that would be a gain about 843 if you use the regular size contract, and 1/10 of that if you use the micros. And the micros are interesting in currency. They trade quite a bit. One thing I would mention about, we talk about these futures products all the time, and there's just a broad range of products to use in different futures markets to express in different ways. Even in the currencies that Bob mentioned, there's a highly liquid options market. There's the big contract, which is the regular British pound contract. Then also the micro, which is 1/10. So if you don't have a strong position, you're just cutting your teeth on trading, there's kind of something for everybody there. I like that. If it goes up to your target, that's a gain of 843. Like I said, she also talked about crude. And
if I could real quick with that British pound, but I want to go back to the micros, which you mentioned they're getting more liquid, and they're being traded a lot. Mm-hmm. That's exactly where I'll affect that trade, simply because, as I said, I'm likely to exit a few pennies before 140, but I might actually just exit 2, exit 3, because I would do 10 of those. So I'd exit 2 or 3 or 4 of them at a time as we move up, and then possibly even extend it past 140.
I like that a lot. Let's talk to crude. The show's going quick. We got to move. Crude. I saw you were bullish on crude. Carly's bearish. Make the case.
So my case on crude essentially has to do with the supply and demand story, the fundamentals. And by the way, I worked at an oil company, so I'm one of the guys you're talking about. At least I used to be, but I still talk to a lot of those guys. So I know things about crude, the speed crude flows through a pipe, and I know what refinery utilization should be and what it means and things like that. But I still do price action, because it's just as important. So what I do is I take a fundamental story and I look at the price action. That puts me in a very similar situation. Because crude oil has been so volatile in the short term, I got a wide stop on this. but I want to buy at 59.05. And again, that's not going to mean that Carly's wrong. It's just going to mean there's a pullback and a bounce. And I think there will be a pullback. So I want to buy at about 59.05. My stop's about 57.15, which is big if you're using the big crude oil contract. I'm looking for $64. Then I'm looking for it to fall from there, because I just think that's one of those targets that the fundamental oil guys are looking for.
And I really like that trade. And I'd like to mention, we talked about broadness of products before too. There's the regular crude contract, and there's the mini crude, which is a half of what the regular is. I got that right, don't I, Bobby? So if you use that, so if you use Bobby's, the big contract, it'd be 24.75 gain versus a potential 950 loss, and it'd be half that if you use the other. When you said fundamentals versus technicals, if you look at yourself, because I always say to myself, I'm 65%, 75% technicals, and then I use, whatever, the remaining is fundamentals, and I mostly use it just to bolster my story. Does those sound legitimate to you?
In both
like you?
Stock Think Tank and Path Trading Partners, which is our analytics firm, I will come up with a fundamental thesis. My technical team, who's basically one really smart guy, can veto it simply because the price action doesn't follow along. And it's that way with crude oil. The Texas storm is what changed it for me. You're looking at a storm that temporarily took 4 million barrels a day off production. Probably 600 to 800,000 of that's permanent, because they're smaller wells and they're too difficult to reopen. They're too expensive to reopen. That's why I just think we're pricing into a new range. And then I think when it gets extended, it'll sell off the way Carly thinks.
Okay, stocks. Let's go to stocks. So yesterday, you saw the volatility in stocks. There's tremendous volatility today too. I describe it as two reasons. One, the fact that the bonds are having attention. The stocks don't like when any big market is going through something. It automatically could reverberate to other things, and people get kind of cautious on risk assets. Now, the second thing is the bond market was telling us that there's inflation. My belief is that stocks like inflation. What they don't like is the Fed noticing that there's inflation. They would rather have an oblivious Fed, which is what we had up until this point. And now the bond market is telling the Fed, oh no, it's out there and you have to tighten way earlier than you think. Do you like that characterization?
I do, and I don't think they will, and that's why it worries me. I think we'll get a little exuberance when the stimulus passes, which it's going to on some level. I'm glad, and you are too, as a restaurant owner, that maybe you are, maybe you're not, that they didn't get through with that minimum wage, at least not so far. Because if they do, you got to buy robotics companies that flip burgers. One of them's already in White Castle. I'm not going to mention a stock. The fact of the matter is, to me, is that inflation is coming and you get more stimulus. Did you see the savings rate today? The savings rate data and the personal income data last time that spiked was on the last stimulus. So that tells you this stimulus check, it's going to get there, it's going to get spent, and it's going to be chasing fewer goods because of the permanent closures through the pandemic.
Oh yeah, there's inflation. I don't even know what they're looking at when they say there's not inflation. Tell them to look at lumber, look at Bitcoin. The dollar is dramatically weakening against everything except for what they're looking at against it, which is the euro and the yen. So I'm going to give my trade example too, and I actually have it on too. I do these flies all the time, and I'm going to do another one. The technical analysis in this is this: the 3,800 level is a significant level, and it defended it many times yesterday and many times today. As a matter of fact, it went through it once today and then quickly rejected it. So I still am respecting that level. So here's what I got on. It's the week 1 March. So that's next week, March 5th, the 3,900, 3,940, 3,975 broken call fly. And again, if you guys don't understand this, I know I talk about these all the time. If you don't get it, just Twitter me and I'll give you Bobby's cell phone number. It's what we're doing is we're buying the 40 tick wide call spread, 3,900 to 3,940, and then selling the 35 tick wide call spread above it, the 3,940, 3,975. So I put that on for 7 ticks. So it cost me $350 to potentially make $1,650. I'm not going to make all $1,650. If it starts heading up there, I just plan on deciding what would be a good profit depending on how many days it has left. Now, the good thing about this is that I paid 7 ticks for it. And this is what happened last time in the show. It shot, I got the direction right. It shot way higher. But my consolation prize was I didn't lose all my money. I still made that 5 tick difference, which, I was not pleased with that. But that's what happened. Thoughts on the trade?
Well, first of all, that's risk mitigation. Second of all, turn on your Bloomberg because you're going to freak out when the show's over that your Bloomberg's not on.
I hate that. Thank you.
You're going to be like, well, I got to look at my trades and the thing's off.
I thought maybe I didn't pay my bill.
I like the strikes a lot. I like the broken call fly. I don't short term. It's not that I don't agree with the direction. I think we're going to get a pop of the stimulus. So I think it's probably the right trade. But I'm just so concerned with what's going to happen with this inflation narrative and with treasuries. And I don't necessarily think the stimulus is going to be able to kind of wash that away short term. But the good thing is it's a week one. So I'm going to go in the camp of liking this trade. And if you're twittering Jimmy, you probably would rather tweet me because you feel like
Did I say twittering?
Tweet versus Twitter, first of all. But yeah, but no,
Okay.
Twitter Jimmy. If you actually find a way to Twitter him, I'll actually give myself on that.
Okay, let's talk about bonds real quick. We had an enormous move yesterday. I think it was one of the biggest things that happened in markets in a long time. Is the bond market just said enough? The bond market said you have to open the economy back up because you no longer can just stimulate it with spending crap tons of money and keeping rates at zero until we're all in the nursing home. And I think it was a powerful statement that it made. I'm not overselling it. You think it was a big deal too, right?
Yes, I do. I think it was a huge, huge deal. I've always liked when Fed chairs actually scold Congress. I don't think Jerome Powell has done it enough. I watched 1 minute of the Q&A and I twittered that I needed to turn it off because politicians are just useless when it comes to any sort of economics or market-based discussion. So I didn't even watch it. So yeah, I think it's a massive statement. And that's kind of my point when we were talking earlier. There's fewer businesses to drive the economy now by a large number. And that bothers me.
Now, I have a short-term trade that might surprise you if it's going the other way. Because last time we were on the show, which was a month ago, both of us talked about massive curve steepening. It happened, pat myself on the back for that. The options I had on were not the right dates. By the way, Bobby's two trades were both perfect. My idea was right. My strategy was wrong. I think there's going to be a bounce up in the next 2 weeks. I am long the 133.5, 134, 134.5 call fly. I paid 5 ticks for that. So it's paid $78 to make a potential 493. So basically to make a potential, a potential 422. Sorry about that. So that I got 2 weeks for that. I think there's a bounce up. If there's a bounce up in the next couple of days, I'll just cover it and make a little bit of a profit. Again, like what Carly said too, the world looks over and says, oh, wow, there's 1 point whatever interest rates here. Maybe it's time to buy US because they have higher rates than everybody else. Do you think there's a potential for a bit of a pullback?
I do. I'm actually really on board with that trade where I was waffling on the S&P trade. Now I think rates are going higher, but things don't move in a straight line in markets, especially when they move quickly in the beginning of that move. So I think the longer term interest rate direction is higher in yields, lower in price. When it's changing a trend and it moves as fast as it did this week, and you and I know you've been doing this for almost 30, I've been doing this for almost 30. These were fast moves for treasuries. That was insane.
Unbelievably fast. Yeah.
So I think the direction for yields is higher and prices down, but I believe that timing of your trade is exactly right. There's going to be a rebound.
Good. Are we just about out of time? Got your stopwatch on there?
Yeah, we are. I mean, it's our show, so who cares?
So keep going. There's one thing I want to mention to you guys. Last week, we got a ton of great feedback. People were twittering us. Yeah, that's what I said, Bob. People were tweeting us and saying what they liked, what they didn't like. And I thought it was really cool. I know it's a Friday afternoon and you guys have a lot of other things you could be doing than listening to old guys talk about markets. And I appreciate that you're here because, again, it's one of my favorite things to do is to trade and then to talk about trading. In a couple hours, I'll go to the bar and talk about trading a little bit more. So my wife gets sick of it, but whatever, she's got to live with it. Bob, any closing thoughts?
Yeah, I would say, first of all, I don't age, you do. So it's one old guy.
Look at the gray hair. What happened? We used to be young. It's so irritating.
You looked young when you were in your 30s, and now you look old when you're in your, well, whatever.
Let's start wearing makeup.
I guess that's the way it's supposed to work. No, I just think that the Treasury move it's what we've been looking at. There were times last year where we saw Treasuries get corrected by the rest of the market, right? Where commodities were moving in a bullish path, stocks were moving in a bullish path, and treasuries were moving in a bearish path. Now treasuries to me seem right. And the market's actually responding rather than going in the same direction in terms of price now I'm talking as the stock market. So it is to me the most critical thing to watch over the next couple of weeks. And then I think this non-farm payroll that's coming up is going to be huge.
No, yeah, this is going to be the first one that's huge. This is the first one that they were actually starting to begin some sort of recovery. And again, I underscore that I think the move in the bond market was enormous as well. I think the bond market is screaming at the federal government and the Fed that they must stop with cavalier currency policies and all that tomfoolery. That's an old school word I thought you might like there. And the malarkey of all their currency manipulations. I'm going.
You gotta stop.
I gotta stop. So I will be stopping. And thank you guys for joining us. We really do appreciate it very much in all seriousness. Thanks. Have a good day.